could include superannuation. I mean, your superannuation would be in a managed fund, or your super fund would invest in other managed funds. They call that a fund of funds. So there's been a lot of growth, and that's because, guys, what percent of everyone's wage goes into superannuation?
None.
Oh, you just gonna yeah. What was that? Sorry. Yeah, I think 9.5, isn't it? But it's going up every year. Eventually, I think it's going to get to 12.5 by some point. Yeah. So, and that's compulsory, not voluntary. So there's just a huge amount of money pouring in there. Even if no one wants to invest, they must. A lot of that ends up in managed funds. So I worked for a financial planner that would invest people's superannuation, and they put money in ones like Asgard, random. Yeah, Macquarie. Yep. Citi, the Citigroup funds. Like it'll be Macquarie Infrastructure Fund, Citigroup Bond Fund, or something. You know what I mean? Magellan, that's one I saw. Magellan Fund or something. Like there's so many, guys. You know, Perpetual Fund. There's all these random funds, and then there's the overseas ones as well. Like the what's that big famous one? Jack Bogle, Vanguard. They're really cheap. They just invest in the index. I think it's spelled like that. So they're all sort of types of funds that often invest super. So yeah, managed funds. So they can be organised as a mutual fund in the USA. Often there is trusts. The reason they're done as trusts in Australia and UK is trusts are what's called pass-through entities. Does anyone know what that means? Yeah. Good, which means they pay high or low or no tax. No.
No tax.
Well, yeah, you must pay personal tax, but there's no tax paid at the trust level. So if you have a company in the US, you get double taxed, don't you? You get taxed at the corporate level, and again when the person gets the dividend. But if you've got a trust, the money goes straight through, as long as you distribute all the money in the trust, all the profits. The trust doesn't pay any tax. So it's a tax efficient way of structuring a fund if you have a trust. They pay no tax themselves. There's only personal tax paid by, they're called the beneficiaries or the unit holders. So you know how in companies you have shareholders, in trusts you have unit holders. In companies, the company pays a dividend. In a trust, they pay a distribution. Basically, the same thing. Yeah. So that's why trusts are popular. In USA, they often don't need them because in USA there's this thing called the LLC, and it stands for Limited Liability Company, but it's not a normal company. I had to research this part of my PhD. A lot of people don't know about it. There's actually I think 4 types of companies in the US that have limited liability. One is called the C Corp. I don't know what the C, I assume it means corporation, but it's a corporation. The C Corporation is a regular company, pays tax, has limited liability, can be listed on the exchange, normal. The S Corp, I think it's S for special, I'm not sure. The S Corp is different. The S Corp, maybe that's what it is, C for common, yeah. The S Corporation can't be listed. You cannot be listed on the stock exchange. But it pays no tax. You don't pay any tax on the S Corp, so it can distribute its profits to its shareholders without paying tax. But there are these restrictions. So both S Corps and LLCs. LLC is a limited liability company, but it's not a C Corp. It's not normal. S Corps and LLCs they don't pay any tax, but they have these restrictions that I forget which one's which. They're slightly different. I think LLCs have less restrictions, but you can look them up. But I think that all the investors, have to be American citizens. You can't have more than 100 investors, and they can't be listed on the stock exchange. But some of them have, I don't know, LLCs might have 2 of those 3, and S Corps might have another 3 or 2 or something. But there's these. So the main thing is you can't list them, therefore they're more or less liquid.
Less liquid.
Yeah, less liquid. Yeah. So we can't buy shares in them, and we're not American as well. But they're very common. Rich families own their business as LLCs or S corps because you avoid tax. So it avoids the whole double taxation problem. Yeah. So that's an interesting method to avoid it. We're going to talk about double taxation when we do franking credits. I think next week or week after. It's funny how different countries have different strategies. I think in India, don't they just have no tax on dividends? Or zero tax on dividends? One of my Indian students was telling me. So that means that you're only taxed once at the company level, 30% company tax rate, for example, in Australia. We have franking credits, so that refunds the corporate tax at the personal level. So everyone ends up paying the personal tax. So in America, you just get taxed twice if you've got a C Corp, or if you've got an S Corp, you're only taxed at the company or personal level? Personal, because the company pays no tax if you've got an S or LLC company. Good, guys. Yeah, in Canada also, trusts are very popular, and you can list trust in Canada. Same in Australia. Like, Westfield shopping centres? Their property is owned in a trust because then they don't pay any tax at the corporate level. And you might say that's pointless, you get franking credits. But who are the only people who can use franking credits? Australians, foreigners can't. But half of all shares are owned by foreigners who can't use the franking credits. It's illegal. So that's why Westfield is a trust, because then it can have foreign investors and they don't get taxed because trusts don't pay any tax themselves. So, but in Australia, only property and shares, I think, can be owned as a trust. You can't run a business as a trust. It can't be active investment. It has to be passive, like sitting on a property, sitting on shares. Some people think it's really boring, guys. When I was studying, I thought all this stuff is boring, like admin. But actually, saving money on tax is the easiest way to reduce your expenses. And that's this whole industry, like financial planning, that's all they do, how to save money on tax. And it's the one free lunch. If you think about tax and strategic, you pay less money. And it's ironic I'm teaching that, because who pays me? I'm paid from government taxes. And here I am teaching you guys how to avoid paying tax. That's funny, isn't it? That's finance. So here are the types of managed funds. We've got a whole bunch. Cash management trusts, we talked about them. What do they invest in, guys?
Securities.
In the money market, such as?
Money market and capital market.
Yeah, but cash management is mostly money market, because cash is like short term. So that would be?
CDs. Bank bills.
Bank bills, good. Bank BABs.
Short-term notes.
Yep, like promissory notes, treasury notes maybe. Excellent, guys. Public unit trust. So that's like Westfield is a public. The public means it's listed. Great. So they're trading on the exchange, like Westfield. Another one is GPT, General Property Trust.
Westfield, you're the owner of Westfield Shopping Center.
Frank Lowy. Yeah, Frank Lowy. Rich guy, yep. Yeah, he Westfield's interesting. I think they sold the shopping centre part to a Dutch company, Unibail Rodamco. I only know that because I own shares, but it's complicated. I think they're only buying the overseas ones, not the Australian ones. And Westfield has this funny thing where they were a stapled security before they got bought, where it was a trust and a company, or a trust and a trust together, but the trust owned the property, and I think the company owned the management of the shopping centre. And again, that was to reduce tax, because you can't have a trust structure running an active company to run the shops. You can only have a trust to hold the property. So the trust would just collect rent from Westfield, the company that would run the shopping centre.
So the trust take charge of the property, and Westfield, they take charge of the management.
Yeah, but one was called Westfield Property Trust, the other was called just Westfield Company. But I think they were traded as a stapled security. They were listed together. And it's extremely complicated, the way the tax and the law works. And it's a nightmare trying to figure it out. Every year they release tax guidance on exactly what you're supposed to do, because it's so complicated. Yeah. Anyway, General Property Trust, they still exist as a listed trust. Statutory Life Office, they're just an insurance company, and they tend to buy a lot of shares in property. because they've got to put money away for when you die and then pay you money to your family if something bad happens. Hedge funds. So hedge funds are interesting. They can be structured as a trust or company or whatever, but they tend to be like they try and get like. What can you tell me? Like, what are some peculiarities of hedge funds as opposed to all these other types of funds?
They ask for promise to keep your money for at least for a certain time, like 3 years.
Great.
Years.
Yes, I think they call it a lockout period. Once you buy into them, you're locked out from selling for a couple of years. Excellent. So restrictions on sales, on share sale or ownership sales, ownership sales by investors. Good. That's bad, isn't it? You don't want that. You want liquidity. So they're a little bit illiquid for investors. They tend to invest in stuff that's high or low risk. High risk, yeah, but often they actually get the high risk from they have massive leverage. So they borrow a lot of money. So that they might be investing in government bonds, which are low risk, but they use so much money they borrowed from the bank, and maybe they buy risky government bonds like Greek government bonds, but they could even buy just American government bonds with borrowed money. But because if interest rates change, like interest rates go down, the fixed coupon bond price will go up, yeah. And so they often take bets on yield. They might also buy they might also do short selling. You know, like Tesla short sold a lot. They might do that. They might do they might trade derivatives. Like, tell me some examples of derivatives, guys. Options, nice. Futures, yep. That sort of stuff. CDS, credit default swaps. So very risky. Often they're not listed because they don't want to disclose information. They want to keep it all secret. Common funds, just a fund, just a company or a trust. You know.
Also, they are like private clubs. You need a lot of money to get into.
That's a good point. Excellent. So often their investors are high net worth individuals. Yep. And that's important because ASIC. What does that stand for, guys? ASIC.
Australian Security.
Good. Australian Securities Investment Commission. Good. The American one is SEC, isn't it? Securities Exchange Commission. ASIC. ASIC allow them to take investments from high net worth investors, like rich people, because they're supposed to be informed, and ASIC don't need to protect them. And so hedge funds, can they issue shares on the exchange to the public?
No.
Good. And they wouldn't want to, because to do that, you've got to tell the public about what you're doing. This is what I'm investing in, these are the risks, this is my balance sheet. But guys, hedge funds, they like telling everyone what they're doing, or they want to keep everything secret? Yeah, they want to keep it secret. Yep. So that's why they're usually not listed, they don't tell everyone their strategy. And yeah, they only take investments from the rich people.
Also, they are the ones who manipulates the markets most of the time.
Some people say that. Yep. And they're so angry with Elon Musk because he manipulated the Tesla share price. Because he said, I'm going to take Tesla private and I'm going to pay a high price. The Tesla share price went up by 10% or 13% in one day. And what were the short sellers happy or sad that the Tesla share price went up? Because they lost money. Short sellers lose money. So they're suing him in court because they're saying, like, you've lost us a lot of money and you did it on purpose. And they said that's market manipulation. So it'll be very interesting what happens. I think he might have made a big mistake by doing that.
Yeah. With the hedge fund,
they're suing Elon Musk.
By the they do at
they're funny, even though they're called a hedge fund.
Capital or PE.
Yeah, they might do venture capital. Yeah, they're often called private equity. The ones you're thinking of. Yeah, we're going to do them later as well.
I can do that as well.
So that's interesting. We're going to go over the differences. We should do it now. So private equity are also secretive. They're also high risk. They're also often take investments only by high net worth individuals. There's so many similarities between private equity and hedge funds, but there's one difference, guys. Who invests for the short term? Private equity or hedge funds?
Hedge funds.
Yes, and private equity invests for the long term. That's the major difference that I can see. Like, you know Coles Myer? used to be one company. Yep. Like they owned Myer department stores and Coles supermarkets. But they did badly compared to Woolworths. They were split up. Coles supermarkets was bought by Wesfarmers, who did Bunnings. Myer was bought by private equity. And they took it private. They delisted it. So it was owned by a private company. They tried and improve it, make it more efficient. And after like 3 or 4 years, they floated it again. They sold it. So that's an example of what private equity do. They take a company, try and improve it, and sell it. Yeah. Hedge funds, though, no way would they invest for 4 years. They're trying to make money from like the news straight away.
Also, they don't invest in real assets. They only invest in financial assets.
Yeah, usually. Yep. So hedge funds, I'm sure, like this week, would all be talking about Turkey with the lira, and they'd be taking bets on the lira. Like, oh, we don't think it's going to be such a big crisis. We sent a guy to Turkey. He's talked to some bankers, and he said, "There's no problem. It's going to recover." Okay, buy the lira. And some of the guys says, "No, it's a disaster. Everyone's taking their money out. The president is stuffing the economy up." What does he say? He thinks if interest rates go lower, inflation will fall. That's very against economic wisdom. And they say, no, it's a disaster. Sell. So hedge funds would be trading the lira big time at the moment, or whatever the latest thing is. So guys, an interesting one with hedge funds is, do you remember when the Fukushima nuclear reactor melted down? Because Japan had that tidal wave, tsunami. The nuclear reactor fuel rod dropped in the thing, and they couldn't get it out. It's so hot, so radioactive. They can't even send a robot in there without melting. So as soon as the tsunami hit, have a guess. I think was it at night or daytime? I'm not sure. Guess what happened to share prices in Japan? Rose, fell.
Prices fell.
Yeah, they fell. Yep. And at that stage, no one knew that the nuclear reactor would be as bad as it, like, because tsunamis happen all the time in Japan, but the nuclear reactor was the thing that really made it bad. But if you're a hedge fund, what would you do? Because no one knew about the tsunami; it just happened, didn't it? Yeah. It's just nature or God or something. So the tsunami hits, and you might be a hedge fund manager, and it's midnight, but there'll be someone in the firm watching the news, and they say, "Oh, the tsunami hit. You need to get in here." What trades would you start doing to try and make money? Sorry?
Insurance.
Insurance companies. Would you buy or sell them in Japan?
Buy.
Buy insurance.
Oh. But you can't sell if you don't already have.
Interesting question. So Cherie's right. You want to sell insurance because they're going to gain or lose money after the tsunami. Lose money, yeah. By the way, guys, we're being very cold here. The tsunami was terrible. Lots of people died, and it was horrible, wasn't it? But this is what hedge funds do. They just try and make money from news.
I
So
think you should buy from building construction.
Excellent.
Reconstruction.
Fantastic. Buy the construction companies because the government will pay to rebuild the roads. Sell the insurance companies. But what if you don't own any insurance companies? How can you sell something you don't own?
Short sell.
Nice. How do you short sell?
You lend the share.
Or you borrow them
Borrow
from
the
someone.
share.
Borrow them, yep. And
And
sell them.
sell them again.
Yep.
Give them back.
Sell them to someone else. And later on, you'll have to return the stock to the person.
And give it back to share.
That's it, good guys. So at the start, borrow the stock, sell it, then you receive money, don't you? Then later on, the guy you borrowed it from wants it back, so buy it from someone else later on, and give the guy the share back you borrowed. And you pay him a small fee plus any dividends. Yep. Nice, so that's how you sell something you don't own. And you hope that the share price rises or falls over the time you short sold. Falls, good. You know, normally when you invest in stock,
It's possible at a time of like this, which is obvious results. No one wants to borrow their share. For
good question. Yeah, so as soon as the tsunami happened, everyone realized in Japan, obviously, it's on the news, and share prices would have fallen, and I don't think you can make money from that original fall because everyone knows, don't they? It's obvious. But let's say that you knew, for some reason, that one insurance company insures the town that got hit, and no one else knows that's no one else knows that because they don't study the company. They don't know it as well as you. Well, you could short. So the whole market might sell insurance companies. All insurance companies in Japan might fall, but you know there's one in particular that's going to be bad, and no one realizes. So you could short sell that one, and then eventually everyone would realize that they're the most exposed, or they'd release their results and they'd have the worst losses, and then that'd fall a lot and you'd make money. But you're right, you can't make a profit from short selling something that everyone already knows about because the price would already have fallen. Is that sort of what you're saying?
No,
Sorry.
to make short selling,
Yeah.
you need to borrow the share
Right.
from someone.
Right.
Who will borrow their shares if they know their price gonna go down?
Oh, okay. Like who would lend? Yeah. Well, a lot of these other things, like the managed funds, or the life insurance, they're going to own shares for 30 years until the person working retires, and they're the ones who own a lot of the stock, and it's why would you lend your stock to someone who's betting it's going to fall? You're thinking, well, I should probably sell it, but from their point of view, they've got to buy the whole market. They've got to diversify, and sure, it might fall a bit, but in the next week or something, but it might go up, and they might not believe that it's going to fall. Hence, why they own it, and they may as well lend it, and they'll get a small fee. And why not get a little fee?
Or maybe not actively managed, passive management funds, maybe.
Exactly. Yep. But active ones too would probably lend the stock. Yep. And maybe if they see that there's all these short sellers, maybe they will sell it, because you can actually look up short selling. It's actually really interesting. ASIC, Australian Securities Investment Commission in Australia, give you short selling data that's only about a week old. It's quite interesting to check out. We're going to do more short selling when we do stocks, but we may as well look at it now. It's interesting to see the stocks that are actually short sold. So look at that, guys, 9th of August. That's only a week old. We can look up, the best one is the Excel sheet, because you can sort them. There it is. So here are the companies listed on the stock exchange. Here's their name. I'll just do a quick sort of, and this is like as of 7 days ago. It's really recent. And hedge funds are supposed to provide this data. They have to report. It's the in the rules. I don't know, in the ASIC Corporations Act or something. They must report these short sale positions to ASIC. So a resources company, JB Hi-Fi. Nearly 20% of the stock are being borrowed and short sold. Now, guys, why would that be? Why would why would short sellers? I mean, the short sellers think that JB Hi-Fi share price is going to rise or fall. Fall, yeah. Why might that be? What big American company entered the Australian market last year? Amazon. Excellent. So, why buy your electronics from JB Hi-Fi when you can get it on the internet from Amazon? So maybe the short sellers think they'll be a victim of Amazon. Funny, isn't it? Get another resources company. Domino's Pizza. Interesting. Why do you reckon they're being short sold? So? Excellent. From Pizza Hut? Yeah, maybe. Someone said in my other class, maybe competition from Uber Eats or Deliveroo. Because one of the attractions of Domino's is they've always been good at delivery, but now there's all these other delivery firms. Maybe people buy less pizza now. Interesting. Yeah. Someone also said that apparently they often employ foreigners or international students and pay them less than what they're supposed to, which is a bit of a scandal. So they could get in big trouble. Ingham's, I think they do chickens, don't they? Got no idea why they're being short sold.
Frozen meat.
Frozen meat, okay. Maybe there'll be competition from overseas or something. I thought we were good at agriculture. I thought they'd be taking away market share from other countries. I don't know. Metcash, they own Franklin's You know Franklin's supermarket? Or No Frills supermarket? Anyway, they're being hammered by Aldi. So I think that's why they're being short sold. Myer, why would they be short sold? It's like David Jones, Myer department stores.
They've got this the off season.
Sorry?
Like they have just passed the year end, like the sell up season.
Oh, right, okay. So
Yeah,
less
maybe.
sales. Could be. Some people say they're also a victim of the internet. Like, why would you go to Myer to buy a suit? You can get it on the internet.
Got on ASOS.
Oh, ASOS, yeah. Or what's that one?
Next.
Oh, okay.
I just know.
There's another one though, isn't there? The
Yeah.
Iconic. Yeah, a lot of women use Iconic to buy things. Yeah. So yeah, maybe that's why. Vocus, I think they do internet fiber optic or something. Yeah. No idea.
Harvey Norman.
Harvey Norman, they're definitely victim of the internet, aren't they? That's why they're being short sold. Same as JB Hi-Fi. Yep. Don't know what they do. IOOF, they're actually super fund. Not sure why they're being sold. Could be Royal Commission. Apparently they did some things wrong in the Royal Commission. Oh, Australian Agricultural Company. They own 2% of the country. They own a lot of property stations in Northern Territory. I'm not sure why they're being short sold. It's interesting. G8 Education. One of my students has shares in them. They do like tutoring or something. Don't know why they're being short sold. Funny, isn't it?
They do tutoring and they're public company?
Yeah.
Really?
Yeah. Funny, isn't it?
Just service, no publication.
I think so. Yeah. I don't know too much about them, but that's what my students said. They do like tutoring schools or something. Funny. Anyway, so that's short selling. All these shares are being borrowed. But people do invest in these companies. It's just, I guess, there's a wide divergence of the short sellers think it's going to fall. Everyone else who's lending the stock and owns it thinks it's going to rise, I guess. So big divergence of opinion. Interesting. Hey guys, there's a saying, buy low, sell high, right? How would you change that saying to do short selling? Short selling is not buy low, then sell high. Short selling is
I sell low.
Borrow high.
not buy high, sell low, that would raise money.
Sell high, buy low.
Borrow high, sell low.
How was that?
Sell high, buy low.
Sell high, buy low. Because you borrow, then you sell, don't you, first? And then later on,
You bought it back.
you buy it later. So instead of buy low, sell high, buy low. Funny, with borrowing before you sell it, obviously. Funny, isn't it? Good. All right. Geez, time goes quick, huh? Well, I think a lot of this stuff we can skip. Friendly Society, never heard of them. They're very small. Guys, super fund industry is huge. Look at this. The total assets in managed funds is 1,600 billion. More than 1,000 billion managed by super funds. I think that's much bigger now. That was 2010. I think it's even bigger. Oh, look, grew to 2 billion in 2013. Yeah, I knew it was a lot bigger. Guys, the amount of money in super is more than the country's GDP. Now, GDP is like income per annum. The money in super is wealth, isn't it? So it's different. But yeah, it's a huge amount. Huge amount of super, massive.
How many times of GDP?
Our GDP is about 1.5 trillion, 1,500 billion, and super looks like it's even a little bit bigger than GDP. Yeah. So in other words, all the people who have superannuation, the country would have to work for about a year, GDP, to pay them back all their super money, sort of thing. Or all the people with superannuation, all the old people, could employ everyone in the country for a whole year to work for them only. Yeah. Yeah. So 35% of funds under management is managed funds. Uses of funds, they just buy things, don't they? Buy shopping centres, buy shares, buy whatever, bonds. This is all just marketing stuff, guys. Capital guaranteed, capital stable. That one sounds very low risk, doesn't it? Probably buying government bonds and money market. Capital stable, a little bit more risky. Maybe buying corporate bonds as well. Balanced growth, maybe buying some shares and corporate bonds and government bonds. Managed growth, this sounds the riskiest one. Maybe they're buying mostly shares, just a little bit of cash and bonds. Yeah. But they're marketing things, you don't have to learn that. Every fund has a different name for these categories. Yeah. My super fund is UniSuper, and they've got a internet site. You can choose what you want to put your super into, like which fund. So mine was bloody invested in government bonds and bank bills or like money market. I was like, you idiots, interest rates are so low, it's the last thing I want to buy. So I switched it all into Australian equities. So all my super is in Australian shares, which would be like quite risky. What about you guys? Like, so some of you guys work and have a super account? What do you just leave it to do whatever, or you select things?
Recently started working on to manage that, and I have to choose the securities in which the
Ah, cool, nice. What do you put it in? Do you select or?
I have to still do that. Like I have it with the care super, so they called me up to just review the things that depending on investing.
Ah, cool, nice. And what are you going to choose? Equities like me, or go government bonds, nice and
No,
safe?
definitely not government bonds. Maybe equity and managed.
Ah, I'll go a bit risky. Excellent. High risk, high return, right? Nice. Cash management trust. I thought we did this. Anyway, cash management trust. So they're buying money market things. They're only small. See, mostly cash and deposits. That would be mostly CDs. That's BABs, isn't it? Bills of exchange. Other, probably promissory notes, government bonds, stuff like that. Public unit trust, so public, just they're listed. Lots of different types of trusts. The biggest ones are property trusts in general. And again, they're trusts just because there's tax savings from being a trust. Listed, unlisted, which ones are more liquid, guys?
Listed.
Listed, excellent. Yep.
I have a question about the trusts.
Mm.
If I invest in trust
Mm.
and leave my money for 3 years, let's say, after I get my money back in 3 years, how do I pay back tax? Tax?
Yeah, the way the trust works usually is, so there's so many different types of trust. There's family trust, public trust, I think. I'm not a lawyer, but the way it usually works is, if the trust keeps any profits in the trust, it pays the highest marginal personal tax rate, but the trust pays it, which is 45%. So no one wants to keep money in the trust. They pay all the profits out. When I say money, I just mean the profit. So all profits get distributed as distributions from the trust to you. So every year you would get a distribution from the trust. And then when you take your money out, you'd be taking out the same, not necessarily the same amount you put in, because the trust might be worth more or less, but the trust would not have they would have paid all profits as dividends, 100% payout ratio, to minimize tax. So when you get your money out of the trust, if it's listed, you just sell the units in the trust, like you would a share, and you might be selling it for a price a little bit higher or lower. Or if it's unlisted, you would have to write a letter or apply on the internet to take your money out. They'd probably make you wait a week or two to take it out. And they might even have to sell some of the things they invested in to get the money to pay you. And I'm sure they all work differently, the way the policy works for when you try and take your money out. But it might be worth more or less than what you put in. But the accounting profit, you might take the money out, get paid a distribution. You might reinvest it in the trust. And then when you sell it, you'd have more units in the trust for yourself. But they will not reinvest the money for you, because that would be a tax problem. Yeah. Does that make sense? So just think of it like shares, basically. It's just like shares. The only difference is they have a 100% payout ratio, because they don't want to hold profits and pay the highest tax rate.
For the shares, if you get a dividend, you pay franking credit.
You get the franking credit. Yep.
And if you have a capital gain for more than 1 year, you get 50% discount on the tax rate, I guess.
Yes. Same with trust. I'm not sure, but I'm pretty sure if the value of the trust went up, and you sold the units in the trust for profit, if you held them for 1 year, I'm pretty sure you get a 50% CGT discount.
So I didn't understand the tax advantage.
The tax advantage
of, between buying share or buying trust.
For you and I, who've lived in Australia for more than 6 months, we're Australian taxpayers, having a trust or a company is no advantage, because when you get paid the distribution from the trust, it's income to you. You'll pay at your personal marginal rate. When you get a dividend from an Australian company, you'll get franking credits, which means you get the company tax back too. So you're right, there's no advantage of trust tax-wise for an Australian. But for a foreigner, they can or can't use franking credits. They can't. So the foreigner will always prefer the company with franking credits or the trust. And that's why a lot of listed...
So they pay no tax at all?
well, the foreigner would receive the distribution from the trust, and the trust wouldn't pay any tax. But the foreigner would have to pay tax. I'm not sure if they pay in Australia or in their own country, if there's a tax agreement. Yeah, but they would have to pay personal income tax on that distribution in some country. Yeah. But if they received a dividend on an Australian stock that had franking credits, they couldn't use the franking credit. So effectively, their company would have paid tax at the corporate level, and then they would have to pay tax at the personal level when they got the dividend. So they're being double taxed, which sucks. Yeah. So foreigners would prefer trusts. Let me see if I can find GPT on the ASX, General Property Trust. There it is. Geez, they had a tough time in the GFC, didn't they? Wow. But yeah, there's General Property Trust. I think it's on the ASX. They don't say much about it. Dividends slowly going up, that's all good news. But yeah, you'd have units in General Property Trust. And oh look, they might even be buildings around here, mightn't they? They'd own some of those buildings and collect rent and then pay it out as to their unit holders in the trust. And they wouldn't keep any profits, they pay it all out. Anyway, interesting. See, they call it security price. It's not the share price because they're not shares; they're units. Yeah, that good? Okay. Yeah. So understand. In Canada, they don't have franking credits, I think, and a lot of listed companies are converting from companies to trusts because then you don't pay corporate tax. Yeah.
So foreigner cannot apply the Australian tax office to get back their franking credits.
Foreigners can't use franking credits.
So
I think in New Zealand, foreigners can.
If the corporate pays 30% corporate tax rate, and they cannot claim back their tax.
No. Yep. So foreigners are double taxed in the Australian tax system. Okay. Yeah. Good question. In New Zealand, I think they refund franking credits to foreigners, but not here. Yeah. Excellent. Superannuation, massive sector, largest of the managed funds. And it's funny, guys, the biggest sector in superannuation is self-managed super funds. Do any of you guys have a self-managed super fund? Neither. We're all poor students. They say you need at least, to make it economical, you need about $500,000 or at least $300,000 in your self-managed super fund. Because, I forget, is it ASIC or APRA? One of them makes you get your self-managed super fund audited every year. Because they want to make sure you're not buying like speedboats or jet skis for fun. They want to make sure you are actually investing your money in something that in your retirement you can live off. You can't live off a speedboat. So they make sure that you are actually putting money away for your retirement. But yeah, it's surprising, isn't it? Self-managed super funds are the biggest ones. They're worth $500 billion in assets. Yeah. So they're guys, the rich people who can afford to get their super fund, self-managed super fund audited, and they basically invest their own money in super.
So if you
companies.
have enough capital,
Mm.
you can
Make your own super fund.
construct your own and don't pay the 9.5, 12.5%, whatever the discrimination rate is.
Yeah, so you pay into your own. You put 9.5% of your wage into your own super fund, self-managed. Yep. So so Host Plus or retail super fund or UniSuper, hopefully one day I get some money. If I ever get a lot, then I'm going to take it out, do my own self-managed super fund. That would be fun, wouldn't it? Invest your own stuff instead of let them do it, pay them fees. Who wants to do that? Do it yourself. But to make it economical and worthwhile, you need to have a lot of money because there's big fixed costs. I mean, what do you guys have super? What cost do you pay? I pay about $8 a month in fees.
I really don't know because I just started with it.
Ah, you don't know yet, yeah.
9.5% of my.
Right. My wife, I mean, she was a student and then had a baby, so she hasn't worked for long, but she's got like a couple of thousand in her superannuation. Her investment returns are smaller than her fees. So it's depressing. Every time she gets her super balance, it's just getting smaller and smaller because the fees are bigger than what she makes, which is rotten, isn't it? Yeah, buggers. But
Do the government allow for that?
yep. Yeah. But like, you know, like, and it's annoying. She's just going to lose her $2,000 between now and when she retires 65, unless we put money in from my wage, or unless she starts working later or something. But that's pretty common, I think. A lot of people who don't work get a bit of super. They work once, and then the superannuation fund just takes it all until it's nothing. Yeah. Eventually, if it gets so small, they put it in the government one because they don't even want it. It's so little. It's too much effort. They put it in the government one, and then you have to claim it back. Probably the government takes a little bit all the time too. Yeah, it's annoying. But because once it goes in super, can you take the money out?
No.
How old do you have to be to take it out?
65.
Yeah, or if you can show that you're going to move overseas permanently. So you guys, you know, a lot of you want to go back home if you're from overseas. You can go to the, I'm not sure exactly how you do it, but you write letters to someone or apply on the internet, and they'll pay all your super to your bank account because you're moving back to your own country, and you can get it all back. But if you're going to stay here, if you're going to be a citizen or something, you can't get it out until you're 65, unless you have a massive medical emergency. Yeah. And I think even if you go bankrupt, your super is protected. The creditors can't get your money out of your super. I think, I'm not sure, but I think it's protected. Yeah, so these are the different types of super. The biggest one is self-managed. Crazy, isn't it? So I don't have self-managed super. I would be probably, I think pooled, maybe? Yeah, a pooled superannuation. I don't think I'm a trust. Maybe I'm not sure. Anyway, not self-managed, that's for sure. So where do you get money from? They get the money from us, the workers. Yep, so it's 9% now. So 9.5%, increasing to 12% or 12.5%, I forget, in a couple of years. They're trying to push it up. Now a lot of countries have super, but I think it's usually a lot less. I think someone told me in China they have superannuation, but something like 2% or something. Is that right? I don't know. In Vietnam, do they have it, Peter? Do you have superannuation in Vietnam?
No.
Okay.
They got pension fund. And
Government pension.
Thai is another, a little, like somehow the same, but they call it like a social welfare fund.
They
Right,
are the,
well, that's pension, isn't it?
they are
Yeah.
the compulsory one.
Yes, they also compulsory.
Right, right.
And you have to pay
It
for it.
proportions of total.
Oh, so you do have compulsory superannuation in Vietnam as well?
Yeah, like
What percent of your wage?
as I remember, is 8%.
8% is pretty high, wow.
But
Interesting.
but this is three difference for your like medical for different purpose.
Oh, you can use it for medical stuff too.
Medical stuff for
Retirement.
unemployment and retirement.
Oh, right, you can take it out when you're unemployed.
Yeah, like you are unemployment for 3 months, you can go to the local.
No, that's different story. This is a different story. Social welfare fund and employment insurance is different story.
Oh, okay. Well, I mean, we have both.
Both. Yeah.
Anyway, it's complicated, isn't it? The government want to help people if they're unemployed, help families. So sometimes it's called the dole here, but that's not your money. It's just the government giving you money. They feel sorry for you. But yeah, here superannuation. If you're unemployed, you can't get the money out until you're 65. Yeah, interesting. Anyway, every country has its own thing, doesn't it? It's all different. But this is huge, guys. Like, that's a massive proportion. So yeah, it goes into a whole bunch of different places. Self-managed is the biggest one.
In Australia, superannuation is 10%, right?
Well, it's going to be 10% eventually. I think it's 9.5 at the moment. Maybe it's 10 in this new financial year. I'm not sure.
In Vietnam, also 8%.
All right, that's that's interesting. So guys, in the old days, it was called defined benefit. So these days, most of us have accumulation. This is normal these days. in an accumulation fund, do they promise you $1,000 a week until you die, or is it just this is how much money you've got? Good luck. How does accumulation work? Like, in which one do you get, say, $1,000 every week until you're dead? Is that defined benefit or accumulation?
Accumulation.
It's defined benefit because the benefit is defined as you will get $1,000 every week until you're dead, or $500 a week until you're dead. So that's defined benefit. So that's how it used to work in the old days, or these days still happens in Australia for some public sector employees. So defined benefit is an amount paid, like, usually it's some percent of your salary. So for example, 60% of your salary at retirement is paid to you forever until you're dead. Now guys, I just made 60% up. Different companies have different things. But like, that's an example. So say you earned 100 grand per year when you retired, then you'd get 60 grand a year until you're dead on a defined benefit thing, if that's what the policy said. But it could be 50, it could be 80, it could be, who knows what the percent is. And it might work differently. Maybe it's $200 plus 20% of what you retired on. Yep. But, and this is less and less common. Usually only public sector employees. Like government employees.
Banks. In Turkey, it's popular among bank.
Bank employees get this?
Yeah, bank employees.
Get defined benefit? Wow. In Australia or?
In Turkey.
Turkey, right. Interesting. In Australia, most companies used to do this, defined benefit as well. Guys, this is actually why Ford and General Motors went bankrupt. Ford and General Motors had all these workers, and they all were on defined benefit. And the problem is that the good thing is they all lived for so long. But this is bad for Ford, because they live for so long, and basically doctors can keep them alive forever. Medical bills and all these sort of things, and because they're just living longer, mean that General Motors and Ford just didn't have enough money. So apparently whenever they sold a car, something like $3,000 or $4,000 of the cost of the car was paying the old Americans their pension, their defined benefit pension. Isn't that funny? Yeah. So, I wonder if Turkey will have a similar problem with the bank managers. Have this. So even in the public sector, guys. So I worked I still work for the government at the uni, but when I was working for the Reserve Bank, there was defined benefit accumulation, but everyone had to be on the accumulation, which is normal. And the accumulation is the 9.5% of your wage thing. Yep, they put that in your fund. And it just accumulates. If it goes up a lot, good for you. If it goes down a lot, bad luck. It's your problem. But the old people at the RBA, the managers who've been there for ages, they're on defined benefit. And it's awesome, because money until you die. It's like you won the lottery. It's incredible. No one gets that anymore. It's too good. So the Prime Minister still gets it. Yeah, the Prime Minister gets, I think, 100 grand a year forever until they're dead. All ex-Prime Ministers. But that's like the prize for being the Prime Minister, isn't it? I guess.
Yes. He would use his own.
Sorry?
I mean, if he gets it, he would not use his own money.
Yeah. And I think they're expected to sort of keep working a little bit because they go and give advice and do speeches and stuff. I think the government even pay their flight tickets to go in hotels because they go and help the country by talking and stuff. Funny. So guys, that's the one that we're on, accumulation. Is anyone on defined benefit? Doubt it, yeah. All right, so they're heavily regulated. You get taxed low, which is awesome. Much less than the corporate tax rate or personal. You can withdraw money at 60. I thought it was 65. That's funny. These slides are a little bit old. I thought that maybe they put that up. We should double check that. But you can't get it out before then, forget it. They now limit your maximum contributions. They didn't used to. Rich people used to stuff all this money in they could because you only get taxed 15%. But these days they limit it. I think you can't put in more than $25,000 a year these days. Yeah. because the government didn't want rich people to avoid paying taxes. Life insurance, they just put money away, they invest your premiums to pay your family if you ever pass away in some accident. Yep. Use of funds,
So
investing.
Is the superannuation is tax free? You deduct the superannuation before the income tax?
Yeah, good question. So if you get paid $1,000, 9.5%, so what's that, $95 will be paid into superannuation. And you will pay 15% on the money going into super. Yep.
So tax rate is fixed for 15.
Yes. Yep.
It goes up to 45.
Yes. So on that $95, the 15%, you will pay 9.5%. You'll pay 15% tax. So the whole 95 won't go into your super. 15% of that 95 will go to the government. And then so let's say there's about $80 left. Then and then over the year that you earn 10%. Your stocks go up by 10%, or 10% dividend. So now you've gone from 80 to 90, but on the money in the super, that also gets taxed at 15%. So the government would take 15% of the $10 increase. So basically, money that goes into super gets taxed at 15%, but doesn't get taxed at your personal marginal rate. And any money you earn in the super gets taxed at 15%. But it gets a little bit more complicated. Once you reach preservation age, which is when you can get the money out, I think it's 60 or 65. After that, I'm not 100% sure about this, but apparently after that, any money you earn in your super account and any money you take out is tax-free. So after 65, if you make 10%, it's all yours, no 15% tax. But up to 65, any money any returns in your super fund are taxed at 15%. You can see how complicated it is. You can see why people need a financial planner, can't you? You know, I'm struggling to learn it and explain it, and yeah. But then in your $1,000 income, you paid 95 into super, taxed at 15%. But the other $905 would be taxed at your personal marginal rate. And so it's funny, right? Like my wife, she's not working. She's earning less than $18,200, so she's below the tax-free threshold. So should she put money in her superannuation account to invest? Why not?
So you're gonna pay 15% tax.
Good, but if she holds it in her own name, how much tax does she pay? Zero. That's funny, isn't it? Low-income people have no incentive to put money in super. So the government tries to fix that. The government actually match if low-income people put money in super. I think the government match it like up to $1,000. If you put $1,000 up to $1,000 in your super, I think the government put in $1,000 too, to try and encourage low-income people to save money in their super. But it's sort of not in their interest, even if the government does put money in. Because if you have a lot of money in your super, can you get the pension? No. Like the government only pay you the pension if you're poor. So if you've got lots of super, you won't get the pension. You know what I mean? So that's why the government try and encourage poor people to put money in super, because it'll mean the government don't have to pay their pension so much later. So, yeah, it's interesting, isn't it? Anyway, yeah, funny.
So the luckiest persons about the tax are over 65 and self-managed superannuation funds. If you own superannuation funds, self-managed superannuation fund, and if you are over 65,
Mm-hmm.
you basically pay no tax.
No tax, yep. Now the other problem with super, which a lot of people are afraid of, you know how it's stuck in there until you're 65. What if you put a whole bunch of money in super and then the government changed the rules? That's what everyone is afraid of. So on the one hand, super is low taxed, it's very attractive. Everyone is freaking out though that the government could change the rules at any time, and all of a sudden your money is stuck in super and it's not a good deal anymore. And you can't get it out because you can't until you're 65. So Labor have already started doing this. You hear about the thing how it's actually to do with franking credits. Labor are trying to make it so that people can't get a refund on franking credits. So there's all these retirees who are older than 65. They've got all their money in shares. Yeah, they've got huge retirement savings. They've got maybe self-managed super or something. They get their actually it only applies to self-managed super people. They get their the dividend from the share, which comes fully franked. They actually get a refund of the franking credit because their income is zero. Besides they're on the lowest tax threshold. their only income is from the dividends because they're not working, they're retired. So they're earning less than 18,200. Their marginal tax rate is nothing, but they get the franking credit, so they can actually get a refund of the entire franking credit. So instead of the government taxing their income, the government actually pay them money to refund the corporate tax paid at the corporate level. Now Labor are trying to get rid of that. But that's really annoying for all these people because they've had all their money in these shares and they've bought all these shares. And Labor are now making it so that shares aren't as attractive because you can't use the franking credit unless you have an income from like, or you basically can't get the refund from the franking credit, which means that if you've got an income less than whatever the 30% tax rate is personal, you're not going to get extra money from the franking credit. So already Labor are changing the rules on franking credits, which affects superannuation. But who knows what else they'll do. Apparently in Poland, during the European financial crisis, or sovereign debt crisis, the Polish government just stole everyone's superannuation. And what can you do about it when the government just steals your money, you know? So all these people who worked hard and saved, government just stole all their money and now they've got nothing. But that could happen in any country, really, couldn't it, that has a crisis? So, so that's why some people say, yeah, don't invest in super, dumb idea. Like, don't put extra money in super than what you're supposed to. Yeah. Do you guys have any stories about, you know, rip-offs in your country or other countries you've heard of? Yeah. Anyway, so some people would say that's like regulatory risk that they pull the rug from under you, they move the goalposts, and super is all of a sudden a bad investment. So APRA regulates super, Prudential Regulator. ASIC does as well. I'm not sure how they divide the. APRA also regulate the life insurance. Yep. General insurance, they just do like house and contents, motor vehicle, health insurance, that sort of stuff. So they invest premiums. Apparently with an insurance company, if you get their premiums they receive minus the outflows of paying people who have accidents, there's more outflows than premiums. So they're making losses on that. The way they make money is from investing the premiums in shares or bonds or whatever. So yeah, general insurance, 4.4% of assets. Hedge funds, we talked about them. Hedge funds are, just say again quickly guys, high risk, high or low leverage. Guys, high or low leverage? High, which means they invest in a lot of debt or they are funded by a lot of debt. Funded by debt, excellent. They like being public or they're secretive?
Secret.
Yep. They're often listed or private companies? Private, excellent. That's not a rule. I'm sure there will be some listed, but not usually listed. Because when you list, you've got to tell everyone your plan, haven't you? You've got to make a prospectus, release your balance sheet. They want to keep everything secret. And they only let investors who are rich, good, high net worth. High net worth investors. So no prospectus needed to raise funds. Because if you get the public to invest in your company, you must issue a prospectus and tell them all about your strategy. They don't want to do that. So they get the high net worth investors who are sophisticated investors. We should put that in here. High net worth investors are thought to be sophisticated by ASIC, so they don't need ASIC's protection like the public. Joe Blow. Yep. Yep. Excellent. Joe Blow, you know, Joe Average. What's it in Turkey? Fulani al-Fulani. Yeah, you know what I'm talking about?
No.
Random person, like in America, John Doe,
Yeah.
Joe Blow, Joe Schmo, Fulani Al-Fulani. Isn't that in Turkey what they call it? Fulani Al-Fulani. Fulani, yeah, like some random person. In China, Wang Omazi. Wang Omazi. You heard of that? Oh man. In Germany, Eric Mustermann. And just like Joe Average, yeah. I thought that was a Turkish one, Fulani Al-Fulani. Maybe I'm saying it wrong.
No.
Just like the typical
maybe
person.
it's about the pronunciation, but I don't remember. I think we don't have a.
Because I got it off Wikipedia. Fulani Al-Fulani.
It sounds Arabic.
Ah, okay. I thought it was Turkish as well. Joe Blow. John Doe. Yeah. John Q Club Public. Okay. Just some random person, just an expression.
So in Australia is Joe Blow?
Yeah, Joe Blow or John Average. Yeah, just some typical names. John Smith, you know. Yeah, Joe Citizen or something. Yeah, Joe Blow, Joe Sixpack, Joe Schmo. Funny, isn't it? Anyway, so just the average person. Yeah. So the key thing is they invest short term. They invest in for the short term. Unlike private equity. Yeah, that's the key thing.
But by doing this, the government allowing these sophisticated people to manipulate the whole market.
I guess. I mean,
These
you
are
call it
burdens.
manipulation. They would call it, or an economist would call it, price discovery. They help the market have fair prices because they're doing research, trying to find out how they're going to. I mean, they're just trying to make money. They're greedy, but they're doing research, and by doing research, they buy things that are underpriced, sell things that are overpriced. They help prices be correct, which helps everyone allocate money to productive things. But yeah, you could say maybe they manipulate the market. That would be illegal if they're manipulating for their own advantage. Like Elon Musk he could be prosecuted, he's being investigated by the SEC for market manipulation because he said Tesla was going to be bought out. But then he said funding was secured, but it's not. So the share price went up because everyone thought it was going to be bought, but it's not. So he manipulated the share price. So he might be prosecuted for market manipulation. But yeah, so hedge funds might try and do that, but it strictly is illegal. You could be investigated for manipulating the market. Any comments?
I still believe these are the dirtiest guys in the financial market.
They are. Yeah, it's true. Yeah. What's that Hungarian guy? The American Hungarian? Blackman? Bill Ackman. Oh, he's a hedge fund manager. Yeah. There's another one who's infamous. Old guy. The Malaysian Prime Minister hated him. Do you guys know he's super rich billionaire? I'll find his name because he's an interesting one. He's a hedge fund manager, and a lot of people blame him for ruining whole countries. George Soros. Yeah, look, people found it. You've heard of Soros before?
Yeah. Sure sell the bonds.
Short sell.
Bonds. British bonds.
Yes, he beat the Bank of England, and yep, he shorted the pound and won. George Soros. Yep, and a lot of Asian countries' leaders blame him for the Asian financial crisis that ruined Indonesia, Malaysia. A lot of people really hate him. But he made a lot of money, and you could say, on the one hand, maybe he says he didn't cause the crisis. He said he just made everyone aware of it, and then suddenly everyone realized and the price of their currency fell. So, I mean, there's different ways of painting the picture, aren't there? But yeah, a lot of people hate him, George Soros. He's the infamous. So I'm sure he'd be involved in the emerging market problems at the moment, betting against things. Look at all the things he's done. Where's the bank of 92 pounds short? Soros has been building a big short position in pound sterling for months, leading up to September 92. And guys, he was short, so he would have been selling the pound. And this is, I think, when the Bank of England had a fixed exchange rate. Yeah, they had this fixed exchange rate mechanism. So he's betting the pound would fall. He sold $10 billion in pounds. Wow. The UK withdrew from the exchange rate mechanism, devaluing the pound, and he won. His profit was 1 billion out of 10. Wow. Just made $1 billion. Isn't that amazing? He beat the Bank of England. The man who broke the Bank of England, because they're trying to keep the currency where it is, and he's betting against it, and he won. Anyone doing international finance? Like cross-currency interest rate parity? You're sort of using that theory to bet against. It's interesting. Yeah, as well as but there's a whole bunch of things he did, invested in. I wonder if we've got Asian financial crisis. Yeah. Prime Minister of Malaysia, Mahathir. I think he's back in power, isn't he? He beat Najib. So accused Soros of using the wealth under his control to punish the ASEAN, including Malaysia. Yeah. So that's not right, is it? Mahathir's a little bit racist. Anyway. Oh look, Mahathir met Soros and accepted he was not responsible for the crisis. Interesting. Soros explained his role in the crisis as follows. The financial crisis that originated in Thailand in 97 was particularly unnerving because of its scope and severity. By the beginning of 97, it was clear to Soros Fund Management that the difference between the trade account and the capital account was becoming untenable. So this is similar, like they're importing too much stuff, or there's too much investment. We sold short the Thai baht, so he shorted the currency, just like with the pound. The Malaysian ringgit in 97, with maturities ranging from 6 months to a year. He probably used foreign exchange forwards. He sold it forward using an FX forward contract. Oh yeah, look, that is, we entered into contracts to deliver at future dates. Foreign exchange forward contracts. Subsequently, Mahathir accused me of causing the crisis, a wholly unfounded accusation. We were not sellers of the currency during or several months before the crisis. On the contrary, we were buyers when the currencies began to decline. We were purchasing ringgits to realise the profits on our earlier speculation. So he's saying he speculated before the crisis, and he was right. But not at the time, he wasn't selling. Much too soon as it turned out, we left most of the potential gain on the table because we were afraid that Mahathir would impose capital controls. He did so, but much later. Interesting, isn't it? So the hedge fund was afraid that the Prime Minister of Malaysia would impose capital controls. What does that mean, guys?
They block your account.
Excellent. They won't let you buy or sell Malaysian ringgit.
And
Sell. They won't let you sell. Yep. So they won't let you convert your money into US dollars or whatever currency. And so that would mean that he couldn't take his money out. So he sold anyway, afraid that Mahathir would impose capital controls. Interesting, isn't it? So I bet hedge funds are debating that in Turkey at the moment. Will Erdogan put capital controls on the lira because it's crashing like crazy? But it's really interesting, guys, because if you look at the effect in the Asian countries, it's huge. Especially in Indonesia, the amount that the Indonesian rupiah fell by is massive. There's a graph. 97, all the currencies are indexed at 100. The Indonesian rupiah fell by something like 80 or 70%. It's crazy, isn't it? Massive, massive fall. Malaysia was badly affected. The purple line fell by about 30%. And even Korea. I mean, Korea is a lot more developed than these other countries. Korea is a bit like Japan, you know what I mean? And they fell even by, and they're not in Southeast Asia. They're in the north, aren't they? Northern Hemisphere. So they fell quite a lot as well. Yeah, it's a really hard time. I mean, imagine if you're an Indonesian, any products that come from overseas would increase by 5 times. Any interest you owe in US dollars would go up by 5 times. So that's why a lot of businesses went bankrupt in this crisis. I've had students whose parents went bankrupt. I had a Korean guy in one of my classes whose parents went bankrupt in the financial crisis because they borrowed in US dollars and the interest went up way too much to pay back the interest. Like, because you're paying in Korean won, but your interest bill is in US dollars. Yeah. Interesting. Anyway, that's hedge funds. They're always trying to figure out money. Yeah, so they use sophisticated investment strategies like the one we just saw, Soros, who used foreign exchange forwards to bet against the Malaysian ringgit. They do short selling, like with Tesla. They're betting Tesla's going to fall. All sorts of things. Bonds, commodities. Yep. High leverage, a lot of debt funding. Use of derivatives like Soros, who used foreign exchange forwards. Finance companies, there's borrow and lend. But they can't borrow from depositors, right? They're not a bank. That's the key thing. Yep. They're very small. Most of them are a lot of them are affiliated with car companies or equipment companies like Caterpillar, bulldozers. They would have a finance department. A lot of these businesses that have finance departments, like especially the car companies, they actually make most of their money from the finance department, not from selling cars. Because if you can get someone to buy a car loan at an interest rate of like 15% per annum, what a rip-off. You're charging a fortune for interest. And so often the car companies make, the loan companies make good money. I've had lots of students who lend money for car loans. Some people say they even charge their clients interest rates of as much as 15 or 20%. It's huge, right? It's like credit card levels, but they're borrowing $30,000 to buy a car. Idiots. I don't know why they would do that. Anyway, interesting.
So what's the advantage for the buyer? They don't restrict it like the bank.
Yeah, well, for the buyer of the car, why would they borrow using the finance company and the car manufacturer? Is that what you're saying? Like, why would you use Ford Credit to buy your Ford car?
Yes, instead of getting a credit from a bank.
Yeah, well, look, I guess they obviously don't have the money to buy the car, and so they need to borrow it. And I guess some are probably a bit silly. They don't get a quote, and they just go in the front door and get ripped off. They don't go to the bank. But yeah, maybe the bank doesn't want to lend to them. They think they're too risky. Maybe Ford want to because they make good money on the car as well. Maybe. Yeah, but good question. I think it's a really dumb idea. Never borrow to buy a car. It's not investment, is it? It's a wasting asset. The price will only fall. So yeah, don't ask me. You asked me to think like an idiot. I don't know
Most
why you
probably,
would.
they're more flexible than banks for giving a loan.
Probably. I
The
think
bank
you're right.
needs some requirement to make the loan, like stricter, like stable income, or you
Yeah.
need like over like 25 or something. Need a guarantee, guarantee. But for credit, maybe not.
That makes sense. Yep,
Yeah.
I'd agree with that. Yeah.
So
I think you do have to prove your income, even if you go to buy a car
Yeah.
on a loan. I think you do have to prove it.
yeah, like
But,
you need like a bank payment to prove for the bank. Like I have stable payment, but most of the students like work in the restaurant, they receive the cash.
That's true. That's
Yeah,
true.
Cannot prove for that.
So they might be a bit easier to get credit. Yeah, I like your points. Yeah, that's a good point. Yeah, a lot of building companies also buy stuff on credit from like the bulldozers and stuff and trucks. But there's sort of they might be able to get a loan from the bank. But the other reason is if the bank were to loan the money for the car, the loan is secured or unsecured. It's secured, yeah, and the bank would secure the loan against the car, and so would the finance company. But if the person doesn't pay back the loan, the bank or finance company would take the car. But who's in a better position to sell the car? Westpac Bank or Ford Motor Company?
More.
Exactly, because they sell cars all the time, don't they? So maybe that's why. Maybe they can offer a slightly better interest rate, because if they do have to repossess the car, they can more easily sell it, whereas the bank won't be able to get as good a price, do you think? I'm just guessing, but yeah, good question. But where do they get the money from? They must get it from, I guess, shareholders or the bank themselves, like Ford, to lend the money, because they can't take deposits, can they? because they're not ADIs, these finance companies. So source of funds, they can borrow money from banks, issue notes in the capital in the debt markets, borrow from other companies or banks. They could issue bonds, whatever. Get the money from shareholders. Use of funds, like leases are basically like debt, guys. Leasing is like hiring, isn't it? Hire, lease, rent. They all mean the same thing. So if you need a truck in your business, you could buy it, but you don't have the money. So you borrow it, buy the truck, use the truck, sell the truck when you don't need it, pay back the loan. Or you can just hire it. So a lot of people look at leasing as borrowing. It's equivalent to borrowing money and buying the asset yourself. Good. We talked about building societies and whatnot, didn't we, before? Credit unions. EFIC is interesting. It's not very important, but you guys from overseas countries, you might see a product in your own country and notice that we don't have it here. Import it. Yeah. So EFIC are pretty. Oh, sorry. EFIC won't help you with importing. EFIC will help you export. So if you see something here that they don't have in your country, like kangaroo meat or something like random, and you think, oh man, they should have that overseas, EFIC will help you export. Now guys, why do EFIC only help with exports, not imports?
GDP?
Good, well done. GDP equals C I. Yep.
X
minus M. Yeah, so I mean imports, now, imports don't reduce GDP. You only minus them because they're in consumption. That's the only reason it's minus M. It's not like if we import, it's not like Australians make less stuff just because we buy stuff from China. No. Well, it's just that it's counted in consumption, so we minus it from imports because we didn't make it. But if you can export more, GDP will be higher, so the government tries to encourage exports. And so if you guys find something that we have that your country doesn't, you might export it from Australia, and EFIC will help you. They provide financial solutions, so it could be insurance or letters of credit or something like that. Risk management, professional advice, just trying to help you get your business running. So yeah, you guys are in the best position to use EFIC because you're familiar with your own country and might notice things that we have that you don't. Could be cool. All the things they do, trade finance. We talked about that last week, didn't we? Off balance sheet bank activities, didn't we? Letters of credit, letter of guarantee. Didn't we talk about that? Yeah. So if the bank won't give you one, go to EFIC. They'll give you one. Yep. Insurance, all sorts of things. Done. All right. Let's do the discussion paper, guys. How much time do we have?
Half hour. So 20.
15 minutes. Oh man. We had a good discussion though, didn't we? All right. Well, look, I'll give you guys 5 minutes. I want everyone to do maybe we got 3 rows. So you guys do 1 and 2. Oh, I've already done 1. Do 2 and 3, 3 and 4, 2 and 3, 4 and 5, 6. Yep. And then we'll go through the answers. Give your best shot, guys.
Thì bởi vì là thầy chữa anh nuôi cho anh đi coi phim tại vì thầy
I've done the first one already.
Thì hôm qua là thầy không chắc chắn đi kiểu chữa lại cái đúng như đúng không đấy tại vì thầy không cho visa thầy hỏi biết mà.
Are we doing just the question 2?
If you finish, do 3 and 4. Yeah, I mean just, but I want you minimum. Yeah, you guys do. Wait a minute. Front row doing 2 and 3. You're doing 4 and 5. And 6 in the back. Yeah, you do 4 and 5. Like do more if you can. Just in 5 minutes there that we've got. Jess. Looks good. Does anyone else need a sheet? Anyone? Did you girls get a sheet? Good. Excellent. Nice work, guys. Looking good. Have you finished?
Yes.
Wow, awesome. Well done.
I think.
These are the interesting ones, aren't they? Impairment and provision for impairment.
Yeah.
Yeah.
Conflict.
Yes, they're the hard ones, yeah. You've done pretty well with that. Good. And you got the impairment in number 2.
Yeah.
Excellent. Excellent. That's a really tricky one, actually. Can you explain that?
I think this one is like well, when you in option 2, when you have like land a new residence.
Yep.
The reason is when you have one. So I make explanation is when you have one. When you send like in a mortgage, so it means that you have to make a provision that whether or not they cannot pay for the mortgage.
Yes. Good.
So,
And so you recognise your
when-
expense before they actually
yeah,
default.
So when they default, it means no need for provision. They already default, like shut out, go away.
Good, good. And you don't have to expense anything extra, do you?
Yeah.
Because you've already done it.
Yeah.
Nice work. Yep, well done. Maybe I'll get you to explain number 2 then, if you want. Later.
Yeah.
Yeah. Nice.
In Australia,
Mm.
it's financial year starts.
Yeah, the tax financial year starts in July.
Yeah,
first of all, yeah, but different companies have different financial years. I think banks, the Commonwealth, or the West Part, some start do 30th of March.
So on personal level, it starts on July.
Yeah. Yeah. Ends in June 30th, starts July 1st. It's financial year. So FY, financial year 2019 is now. Yeah. Confusing. Same in Turkey?
It starts in January.
January, right. You've got logic. Yeah. I think because everyone goes on holiday in Australia in the summer in January 1st. And everyone has to do these accounts when they want to go on holiday. It's annoying. That's why they do July. In Turkey, is it winter in December? January?
Yes, it's
Right. It's our summer, so no one wants to do work on their holiday.
They also give you 25 days. You have 25 days to pay
Submit your
your
tax.
Yeah.
Right. I think we get
How
2 or
many?
3 months to pay. We have 2 or 3 months to submit the tax return, and then about a month to pay.
Yeah.
Yeah.
So it's not about giving people space to travel.
I think it still is. Yeah, I think. Well, that's the personal. I don't know about companies. Because the other thing is when companies release their earnings, there's a lot of work to prepare that quickly. Because like if the financial year ended in December 31st, they'd release earnings maybe 2 or 3 weeks later, and then there'd be all these investor presentations. Okay, so what are you going to do now? Here are your earnings. What's your strategy? So they have to do all this work. They don't want to. Well, I assume that's the reason. I don't know for certain, but I assume that's why. Yeah, that's good. There's more there. Have to think about the provisions. Do 2. 2 will help you do 6. Good. Good. Yep. Provisions. Yep. Right. You'll. Yep. Right. Lost. For provisions. Provisions are liability. Yeah. Reserves is like asset revaluation.
So retail property does not have
Nice, good. What are you doing, Josh? Number 6?
I don't know.
That's a hard one. How are you going with that? Done any up and down things? Yeah. Wow. Well done. Anything lost? I charged some fees. Well done. Charging fees. Yeah. More cash. Good. Another loan. Oh, sorry, because I updated. You must have printed this before. Did you? Yeah, I added one. Sorry. Yeah. Good. Good. Down. Nice. Lower cost. Lower cost. So you're saying that fee was that? Fees. Yes. Good. That's good. But you think overall the fees the rest is lost?
Thì thực ra thì
Yeah. Risk weight assets. Yeah. I haven't done think about that one. If you gain cash but you lose the loan, I don't think which one has the risk weight, the cash or the loan? Or both? Yes, the loan has a risk weight, the cash has zero risk weight. So what's the effective risk weighted assets? Now have a careful think about it. It's tricky, that one. 2 and 6 I think are the hardest. I really like your answers. Do you want to show us? What was your name?
Stefan.
Stefan. Do you want to show us yours, Stefan?